Welcome back. My name is Joanna Amberger. I'm the founder of 3 Financial Group, a financial planning firm located here in Honolulu, Hawaii. We help women and the LGBTQ community master their finances, and today we're continuing our multi-part series on investing basics for women. The next component to effectively managing your investment portfolio is systematic rebalancing. So to illustrate, I'm going to assume a very simplified portfolio of 50% stocks and 50% bonds. Now, most likely in the real world, your portfolio will be much more complicated than that, but this is just for illustration purposes. Now, over time, the market will move, as we described a couple of slides ago, and your portfolio will most likely change from that initial 50-50 setup. So let's assume we start off with that 50-50 mix and we let a year go by and we make no changes, and then the portfolio has moved to 60% stock to 40% bonds. Now, several things have likely happened during this time period. First, our portfolio maybe has drifted under our efficient frontier, so it's not as efficient as it could be. It's also possible that our portfolio has shifted in terms of the risk. Now that we have 60% stocks as opposed to 50% stocks, our portfolio is probably a little riskier. So we've got a little bit more risk and our portfolio is not as efficient. So when we rebalance, we're going to take that 10% of stocks that have performed well over the past year, and we're going to sell it, and we're going to buy back bonds, and we're going to reset the portfolio back to that 50-50 target mix. That brings us back to our efficient portfolio. It keeps our risk in line, and it also can help us take advantage of how the market moves. So if we remember that slide before where we saw how the market waves up and down. When the market is waving up, prices are going up. When the market's waving down, prices are also going down. So most likely, if we started with 50% stocks and our stocks were now 60% of the portfolio, those stock prices were probably going up during that time period. So when we're selling off some of the stocks, not everything, we're going to be most likely selling our stocks at a higher point in the market and we'll be buying bonds at a lower point. We're not always going to hit the high or the low, but it does give us the opportunity to likely buy lower and sell higher. And then we can do this logically without the emotion of that roller coaster ride we discussed earlier. Once you've identified which asset allocation choice is most appropriate for your risk tolerance, the next choice you have to make is which investments do you actually put inside of your investment portfolio. And there are 2 very broad choices philosophically that you have to make up front. The first is to decide whether or not you're going to use active managers or are you going to use passive managers. So what is an active manager? An active manager is simply a money manager. Oftentimes we think of mutual fund managers as an example, and they will look into the future, based on economic research, their own models, interviewing different companies, and a lot of times just their own guts as to what they think is going to happen in the future. And then they buy stocks and bonds today in order to take advantage of what they think is going to happen in the future or potentially get out of the way of risks that they think are coming down the road. So the question then becomes, how do those active managers do? So what we do is we compare active managers to their benchmark. So a common benchmark you might be familiar with is the S&P 500. And oftentimes when people talk about the market, they're talking about the S&P 500 or the Dow Jones Industrial Average. And the S&P 500 is simply an index or a list of 500 widely traded U.S. large company stocks. So when we look at active managers' performance, we benchmark them against an index that is comparable to the kind of investments they're doing. When we look at an active manager's performance over time, we see a few things. In any given year, generally speaking, about 2/3 of active managers on average will underperform their benchmarks. When you look at active managers over time, that gets even worse. And the numbers of active managers that can outperform their benchmarks or even hit their benchmarks falls dramatically. When you start adding active managers together, when you build a portfolio with multiple managers, trying to get enough active managers together that can actually beat the benchmark gets even harder. So, one of the first things you can do is decide to not introduce the risk of an active manager in your portfolio and fire your active manager. Thank you for spending time with me today. I hope you've enjoyed the information. Please do continue watching. There are more parts to this series. If you've enjoyed the presentation, please subscribe to our newsletter. Join me on social media where you can find additional information and resources. Poke around on our website and you can learn more about 3 Financial's services and our philosophy. And consider reaching out to us today if you'd like more information or would like to schedule a time to talk to us.